About 6 months ago, I made a video about the SaaSpocalypse. The market had just decided that AI agents were going to eat software as a service, and it repriced the entire sector in about 2 days. Now here's what's happened since then. The index has come back. It's green. Private equity is circling again. Airtable just sold, and Workday is in talks to go private in one of the biggest software buyouts ever. So the question that I want to answer for you in this video is whether or not the SaaSpocalypse has been canceled. Another obvious question is whether or not this whole thing was overblown and whether or not we can just go back to normal. Now the quick answer is no, and the reason why is the most useful thing I can tell you this year. While the crash is over, the thing that the crash was about is not over, and in this video I want to show you what actually happened, which parts are the same boring pattern that we've seen before, and which parts are permanent change, plus what the playbook looks like so that you can continue to succeed with your SaaS. So let's get into it. So here's a quick recap for anyone who missed my last video on this topic, and if you want to watch that video as well, which I'd recommend, you can find that link in the description below. Now, back in January, Anthropic shipped a tool called Claude Cowork, a desktop agent that reads your files, connects to your tools, and does multi-step work all on its own. 2.5 weeks later, they shipped a set of open source plugins for it, including one aimed at legal workflows. Fast forward to February 3rd, and the market did the math out loud. A basket of US software stocks dropped about 6%, the worst single day since the tear-off sell-off the year before. Roughly $285 billion in market value was gone in just 48 hours. Legal and data names got hit the hardest, with one legal services company down almost 20% in a single day, and a major data provider posting its largest single-day decline on record. Now that was just the start, not the end. By the close of Q1, more than $1 trillion had come out of enterprise software companies, and the software ETF was down about 21% year to date. A broader index tracking more than 120 public software companies was down almost 26%. That wasn't even the scariest number. At the March bottom, forward software multiples hit about 22.7 times, which put software below the S&P 500 for the first time in the history of the cloud era. Now think about what that means. For nearly 20 years, software got a premium just for being software. Recurring revenue, high margins, low marginal cost. And at the bottom in March, the market said that that premium was basically gone. The logic was simple, and it even had a name: seat compression. Enterprise software was priced on human headcount, but agents don't need seats. If one agent does the work of 5 people, you don't need 5 licenses, and that is what started the market sell-off. Now here's what happened next, and this is the part that people are referring to when they're starting to question whether or not the SaaSpocalypse has actually been canceled. Now March may have been the bottom, but by late May, many public software companies were back in the green for the year, and some names went on absolute tears. One cloud infrastructure company the market had largely written off as a commodity finished up more than 200% for the year. An observability company was up 76%, a security company 55%, and the deal making came back as well also. Earlier this year, a payroll and HR company got taken private for $16 billion. 2 weeks ago, Airtable agreed to sell to an Italian software holding company for almost $1.3 billion. Last week, Reuters reported that Workday was in talks to go private at roughly $43 billion, which would be one of the largest software buyouts ever. Workday jumped 18% on the news and dragged a bunch of European software names up with it. So on the surface, it looked like we may be heading for a full recovery. Crisis was over and we'd go back to normal. But if you look one level down, it is a completely different story. So as it turns out, the index is green because the biggest infrastructure names have been carrying it. The median software company is still climbing out of a deep hole. You have to look at the spread. On the winning side, that same year, one infrastructure name is up 227%, observability 76%, and security up 55%, like I mentioned before. But on the losing side, over the exact same period, a marketing automation company is down over 50%, one of the best-known CRM and marketing platforms down 46%, and a work management platform down 45%, a collaboration giant down 36%. You can see a pattern here. That's a spread of nearly 280 points between the best and the worst names in the same sector in the same year. And here's the detail that should stop you cold. That CRM and marketing platform that's down 46% grew revenue by 23% with gross margins above 83%. So the business is performing very well, but the market is still cutting it down anyway. As it turns out, the market wasn't pricing the quarter, it was pricing the model. And that's the whole story of 2026 in one sentence. The index recovered, but the verdict did not change. Now, let's separate signal from noise, since a good chunk of what happened is the same movie we've seen 3 or 4 times by now. First, the panics overshoot, but when roughly 3/4 of a software stock screen as oversold, the bounce is violent. One identity company was up 28% in a single session. deepest cuts saw the sharpest snapbacks. That's mechanical, not insight. Second, cheap attracts capital. Multiples got crushed to around 3 times revenue after sitting nearly 7 a year earlier, and that's exactly when private equity shows up. The Airtable deal and the Workday talks aren't a verdict that AI fear was wrong. They're a verdict that prices got low enough to then again be interesting. Third, the exit window follows the public bottom on a lag, usually 2 to 4 quarters, and that's the same pattern we've seen in 2022, 2008, and 2001. If you only had those 3, you conclude that this was a normal cycle and you go back to what you were doing. But I don't want you to do that. Instead, I want you to look at what didn't revert. 4 things changed permanently, and these are the ones that matter to you. 1. The market now prices AI defensibility separately from growth. 2. Companies growing at the same rate can trade 200 points apart based purely on whether their product looks more valuable or less valuable as agents spread. And that's a new axis. It didn't exist 18 months ago, and now it's the first question every buyer, investor, and acquirer asks. 2. Pricing model actually moved. This isn't a forecast anymore, it's in the data. Pure per seat pricing dropped from 21% of SaaS companies to 15% in about 12 months. Hybrid models, a base fee plus consumption, jumped from 27% to 41%. Gartner projects at least 40% of enterprise SaaS spend shifts to usage, agent, or outcome-based pricing by 2030. Now, support tools now charge per resolved conversation, roughly $1 or less each. That's not a pricing experiment, that's the unit of value moving from who logged in to what work actually got done. 3. The efficiency bar reset, and it's not even close. Median annual recurring revenue per employee across a few hundred SaaS companies jumped 29% in 1 year, from about $150K to almost $200K. Public SaaS median runs near about $400K. And look at the AI native cohort. Benchmarking puts best AI native companies averaging around 1 to 1.3 million per employee, with individual companies well past 3 million. One AI app builder crossed 400 million in recurring revenue with only 146 full-time employees. That's not even a double-digit percentage increase. That is an order of magnitude, and what it resets is what investors and acquirers consider normal. And the 4th element here is all about breaking records and speed. The same app builder that we talked about went from 1 million to 100 million in recurring revenue in about 8 months, which is about the fastest anyone has ever seen that be done. It crossed 500 million in June, less than 3 years after being founded, and it's now seeing 1 million new projects a week. Meanwhile, the company that triggered the whole crash shipped the agent in mid-January, shipped 11 plugins for it before that month was even out, and then shipped a security product for it only 3 weeks after that. So that's the real headline here. The development velocity or clock speed of an entire industry went up, and everybody's expectations shifted with it. So what are the companies on the right side of that 280-point spread actually doing differently? 3 things, and you can do all 3 of these at your scale. Move 1 is to ship AI where it beats the old way outright. Not AI sprinkled on top, AI where the new way is exponentially better than the old way. Building a website used to mean picking a host, wrestling with content management systems, hunting for themes, fighting plugins, and losing a week or more. Now you describe what you want and iterate on it, and that result is available for you in less than an hour. That's not a feature, that is a category being rebuilt, and it's why that company is putting up numbers that nobody has seen before. And here's a pretty simple test for you here. If your AI feature saves someone a click, that is a nice to have. But if instead it can remove a step from their process or maybe an entire tool from their stack, that is a key reason why that customer might choose you instead. Now, move 2 here is to use AI to accelerate your own build velocity. Now, the company I've been talking about here, obviously Anthropic, ships at a pace that would have been seen as impossible for a team that size 3 years ago. Shipping an agent in January, plugins in 2.5 weeks later, a security product 3 weeks after that, that pace is crazy. Now, while you obviously may not have their resources, you don't really need them. What you do need is the same operating principle. Every release cycle you compress compounds, since faster cycles mean more shots on goal, which means more chances to find out what your customers really need. The 3rd lever is one that my coaching clients are not leveraging enough, and I'm constantly on them about it. It's less obvious because it's internal, but that doesn't mean it's any less powerful. Now, the real reason behind why revenue per employee can jump nearly 30% in a single year is because companies have stopped hiring for things that agents now handle. One venture firm found its portfolio companies using AI for content and demand generation were running marketing teams 35% smaller than same-stage peers with the same pipeline. Another dataset showed finance teams covering 8 to 12 million per recurring revenue per person versus 4 to 6 million on traditional workflows. As a solo founder, you don't have a marketing team to shrink. You have you, which means the same leverage shows up as scope. The things that you would have hired for or just never did are now a keystroke away. If you leverage these strategies properly, your SaaS can be extremely successful in the AI era. Now, let me bring this all the way down since it's easy to watch a segment about $43 billion buyouts and conclude none of it applies to you. Allow me to make the case as to why these strategies are even more powerful in your hands than any existing enterprise SaaS company today. You don't have an installed base to protect. Every one of those companies that's down 40 or 50% has customers, contracts, a revenue model built around seats they can't casually unwind, and repricing them takes years and a lot of angry renewals. You can pick the right model from the jump. You have no committee. Their agent roadmap goes through a product council, a security review, and a board. Yours goes through you. You're small enough for the gaps and the bifurcation being decided at a category level for big companies. At your size, you get to pick a specific workflow and a specific vertical, which is exactly where AI defensible answers are the easiest to find. Now, the thing to take away from all of this is SaaS isn't dead. $1 trillion came out of it, and then a lot of it came right back. Companies are getting bought at great prices right now, and that opportunity is completely intact. Now, what did die is the assumption that being software was enough. The old playbook, seats and logins for a premium for recurring revenue, is not coming back. The market has already voted on that, and it didn't change its mind during the recovery. The good news is that the new playbook is reasonable for you. It's short, and being small makes it even easier to follow. Now, here's the playbook that I built for my coaching clients, and I encourage you to follow it as well too. Step 1. Answer the defensibility question in writing. Does your product get more valuable as agents spread or less? One sentence, and if you can't write that, that's your first project. Step 2. Decouple your pricing from seats. Move toward the work getting done. Per record, per resolution, document, outcome, hybrid counts here too. It's where most of the market is landing so far, and bonus points for those of you that can build your customers' ROI into your business model. Step 3. Ship one AI feature that removes a step, not one that saves a click. Pick the ugliest part of your customer's workflow and take it out entirely. Step 4. Compress your own build cycle. Measure how long an idea takes to reach a customer today, and then figure out how to cut that in half with the tools you already have. And Step 5. Put agents on your own operations before you hire. Support, triage, research, content, onboarding, whatever. Every function you don't have to staff or scope is margin that you're going to get back. 6. Your homepage and your sales conversations need your AI answer in plain language, since customers, investors, and acquirers are all asking the same question now, and silence reads as, "We don't have one." Step 2 in that playbook is where most of my coaching clients get stuck on, and since moving off seats sounds great until you have to pick an actual number, that's where my free pricing calculator tool comes in. It walks you through the value metrics process, plus how you can charge in the AI era. And if you want to work through your own pricing and AI strategy with me directly, I take on a small number of founders for private one-on-one coaching. You can find links to both of these resources on my site, bootstrappersparadise.com. So, was the SaaSpocalypse actually canceled? Well, the crash was, but the verdict was not. Software still works. It's just that the premium now goes to companies that can prove they get better as AI gets better, instead of companies that are simply holding on to the dying model for dear life. The faster you adapt, the sooner you will succeed. In my next video, I'm going to walk through what's working from a sales perspective for your SaaS in the AI era. So subscribe if you don't want to miss it, and I'll see you in the next one.